You know that high debt is a problem. We have seen, we have gone through what Buffett has told us about debt, and there is enough historical evidence for us to shun companies with high debt on books, right? So, but before just dismissing companies with debt, it is important to look at these questions. What do we actually mean by high debt? What is the level of debt we are comfortable with? These two questions, if we keep in mind and try to answer them, I think we will be in a much better position and have a far more balanced view about debt. So answers to these questions would be, we just try to write in our own words. A high debt company is where the business is incapable of generating enough cash for making the interest payment on the loan. So for example, if a company is having an interest outgo of say about 100 crores per year, and the business itself is not generating 100 crore of cash flows, that means there is huge debt in the company, right? That's a very simple way of understanding what is a high debt company, right? And the second answer to the second question would be, a company would be comfortable with that much amount of debt which it can service and repay through its internal accruals, right? So say for example, if a company is generating 100 crore of cash flows, operating cash flows every year, and they have an interest payment of somewhere around 10 crore or 20 crore, that means it's a comfortable amount of debt which is there on book. Not just the interest amount, I'm talking about the EMI, wherein the interest and the principal, both amount is included. So if they have a liability of paying 20 crore per year and they are producing 100 crore of cash flows every year, that means they are having a comfortable amount of debt, right? So now, when we have seen that what is the problem or what is the difficulty we find in case of consistent compounders at this point of time, where most of them are very highly priced. So what can we do? We can probably do an experiment and invert the situation, and rather than avoiding the companies at all which are having high debt, we should look at companies which have shown a very good track record of managing debt over a long period of time. So in this debt experiment screener, again you can check this screener on the screener. You can go to the screener website and check this screener, and you will find these three are the points which we have put in. Debt to equity of 0.5, more than 0.5. That means a company which is having a reasonably high amount of debt. Interest coverage ratio of more than 5. What does interest coverage ratio of more than 5 says? Interest coverage ratio of more than 5 means the company has 5 times more capability of serving the interest, right? So for example, if you have a interest liability of 1 rupee, the company's cash flows are more than 5 rupees. So that means company has a system, has a comfortable level of cash flows to serve the, and there is a thumb rule also in the investment community, wherein if an interest coverage, if for any business which has debt on its book, if the interest coverage ratio is more than 5 on a sustained basis, you can expect that these companies are having a reasonable amount of capability of serving their debt in a proper way, and hence they are not as risky as a very high debt company would look like. Okay, so when you run this screener, you get this list. You will get around 82 companies, and on the right side you can see some of the names. Some of these names have been uh, have been very good wealth creator over the last 5-10 years. Companies like Tasty Bite, Acrisil, uh, SRF, Minda Industries. So you can see that even though these companies have had uh, a reasonably high debt on books, they have managed it efficiently over long periods of time, and then they have created wealth for the shareholders as well. So don't get us wrong. We are not saying that you should ignore the consistent compounder and only look at the companies which have managed debt. That is not what we are trying to project here. So we are not saying that you screen companies like this only, that go and look at the a screener like a debt experiment screener and look at those companies which have done well and buy shares. That is not we are trying to. That is not we are trying to. I think someone is unmuted. Can you please mute yourself? So, so just being able to manage debt is not enough for a company to be termed as a great investment opportunity. Of course, the best way to earn wealth is to buy best businesses. The businesses and the best businesses are those which hardly require any outside capital or debt to grow themselves. But there is one problem in those businesses. Everybody knows about them, and it reflects in their valuation also. We have seen in our earlier slide that the valuation of these companies are really high. So that is one area which we have to be cognizant of. As in, if you are looking for really great businesses, valuation is something you will not get as per your liking. Plus, if you only look for companies which have been able to serve their debt well, you may miss on the factor that whether the business model is good or the industry structure is good or not. So our focus on this session is to look at the debt part, but that doesn't mean that you will ignore these factors, because business model, industry characteristics, management track record, valuation, all these are important. And only if that business checks through all these criteria, then only it becomes an investment candidate, right?